good afternoon, good evening, depending on where in the world that you are joining us from today. We want to say a big welcome, and we really hope that you're going to enjoy our conversation today, questioning IPS design inclusivity, unlocking fintech and non-bank participation in domestic instant payment systems. For those of you that have never met me before, my name is Sarah Corley. I'm CEO of the Alliance of Digital Finance and Fintech Associations and one of the authors of the assessment on this topic. Very much welcome to all of you. It's great to see some familiar names and new names amongst the participant list joining us today. Before we officially get started, I'll introduce you to all my panelists. I just want to do a couple of quick housekeeping reminders. So at the bottom of the screen, you will find a function called the Q&A, or sometimes it's in the More section for those of you who are joining via a mobile device. We would love to have your questions coming in the Q&A for our panelists. So please make sure you put as many tough and tricky and difficult ones for us to digest and tackle during today's session. We want to hear from you and what's important to you as well. And one more thing, we are recording today's session. So should you really enjoy the session, we would really encourage you to share the link that you'll receive via email with other colleagues, because it's really important for us that this message is heard as far and wide as we possibly can do, because we've got some really interesting findings to share with you today. So you've met me. Now I want to introduce you to our panelists who will be here for this 90-minute session. First, let me introduce very quickly all the panelists. Firstly, we have Nandini Hariarieshwar. Nandini was my co-researcher, my partner through this. Together, we put the document together and did the research, and so I'm delighted she's here to talk through the findings with me. We also have Aidan Ferdinand. Aidan Ferdinand was really a big champion for us for this project and a huge support. And we also want to really thank Aidan and the Interledger Foundation for funding the assessment that happened. We couldn't have done it without you, and we're really glad you're here to share why you decided to fund this work with us on the call. We'll also have Holti Banker joining us for the discussion from the World Bank. And sadly, we were supposed to have Jacqueline Juma from African Lender Foundation join us. Unfortunately, Jacqueline really is not well and is unable to join us live, but she has sent some comments through to me, which I will share on her behalf later on in the programme. Of course, it would be wrong of us to have a conversation about fintechs and non-banks without also including them in the discussion and hearing their voice directly from their markets. So we welcome Selassie Tay from Ghana, Ariane Ferrer from Philippines, Constantia Munoz Torres from Chile, and Danielle Lawrence from South Africa. And together we are going to hopefully bring to life some real world examples of what we found through our research, and hopefully leave you with some key takeaways and messages to act so we can move the needle and unlock this participation. I'm going to stop sharing for a moment because I'd like to hand the mic over to Aidan, who is going to start us off by sort of explaining a little bit more about the Interledger Foundation and why this study really resonated with their vision and mission. So Aidan, across to you.
Thank you, Sarah, and good morning, good afternoon, good evening, everyone. Thank you so much for being here today. My name is Aidan Ferdinand, and on behalf of the Interledger Foundation, I wanted to also extend a very special thanks to everyone who participated in this research. So thank you to the practitioners, the regulators, and the service operators who gave their time to participate in the focus groups. And of course, a special thanks to our research partners, Alliance DFA and Contigo Global, because you have turned that input into something rigorous and I believe something genuinely useful. I'll keep my remarks brief because the real value of the next 90 minutes is in the findings and in hearing directly from the people working on these challenges and opportunities every day. But I will just say a few words about who we are at the Interledger Foundation and why we think the timing behind this work is important and why we support it. For those who are not familiar with us, we are a non-profit grant-making organization that imagines a world where money moves freely and opportunity follows. And we work to achieve this vision by stewarding digital public infrastructure, funding innovators and researchers, and helping to shape the conditions that make this kind of work possible. We are seeing instant payment systems become a core part of national financial infrastructure. And the thing about infrastructure is once governance structures are set and technical standards are adopted, those choices tend to stick. They become very difficult to unwind. And that's what makes the design phase of this kind of work so consequential. And it's exactly why we think this work and this research needed to happen now, while there is still room in many markets to get this right. We came to this with the instinct shaped by our own work on the Interledger protocol, which is an open source, uh, decentralized messaging protocol that when you centralize control over payment infrastructure, you're centralizing who benefits from it. Instant payment systems offer the possibility to break that pattern. They are supposed to be faster, they are supposed to be cheaper, and they are supposed to be open to a broader range of providers than the legacy systems that they have replaced. And on the technical side, in many markets, we think they have delivered. Money moves and it sometimes settles in real time, but technical speed and structural inclusion are not the same thing. The gap between what instant payment systems can promise and who actually gets to participate in them and who ultimately benefits from them, well, the gap exists. And that's what this research was setting out to examine. And I won't speak to what the research found. Nandini and Sarah are going to do a great job at doing that in a moment. But I think for us, the communities and the institutions who serve the communities that we care most about, whether they're fintech serving rural populations, microfinance institutions working with women entrepreneurs, providers building the informal sector workers, these are the communities that we worry can get squeezed out of digital financial services when the economics don't work. And so what this research gives us, I think, is a picture of where those pressure points are, a reminder that the action that we need at the moment is as much political and institutional as it is influenced by technology, but also importantly and excitingly, that the window to influence how these systems are being built is still open in many markets. It will not stay open indefinitely, but every year that passes without addressing these structural challenges is another year in which the architecture becomes a little more entrenched and a little harder to change. So, with that, I'll hand things back over to Sarah and to Nandini, who will walk us through the assessment itself and the key findings in depth. Thank you so much for being here. Thank you for inviting me and the Interledger Foundation into this webinar, and we look forward to a rich conversation over the next hour and a half.
Thank you so much, Adam. As you say, instant payment systems really do offer the ability to replace some of the legacy systems out there, but these gaps between participation and inclusion really do exist. So it is a real pleasure that Nandini and I will now share some of the key findings. And again, just to quickly emphasize, we wouldn't have had these findings without the support of everyone who participated in the focus groups and our association members. So a big thanks to them. And let me start sharing so that Nandini, I think you're up with the first slide.
Again, welcome, and we're so glad to have you all here. We have this slide up because some of you already know this, some of you don't. And when we started having these conversations with our 18 markets that we worked with and talked to, we realized we kind of need to start here. What is an IPS? Why is this assessment important, right? On the left side is kind of an informal instant payment system. Some we see still in many markets today, where it's a confabulation of bilateral and multilateral arrangements made by some different financial service providers, where the end customer might be experiencing interoperability or not, but it's based on a series of bilateral or multilateral relationships. In a more formal instant payment system, you see on the right, and these are the beautiful visuals that Sarah put together, something more centralized, where there's a centralized hub, the instant payment system, that different financial service providers plug into, right? We choose to use there's many definitions of IPS, but we choose to use the one from Africanenda Foundation. IPS are open loop retail payment systems that enable irrevocable, low value digital credit push transactions in near real time. That's pretty important. And use 24 hours a day, 365 a year. IPS are fast payment systems are synonymous. We heard many challenges in domestic instant payment systems. We only focus on domestic. Cross-border is a whole other ball of opportunities and challenges, and we decided not to approach those. We saw that IPS participation remains uneven, right? What does that mean? It means financial service providers don't all plug in immediately, even if an IPS is built. Fintechs and non-banks particularly face challenges to connect and participate in IPS much more so than, let's say, what we call the dominant players, usually banks and MNOs. Interestingly, as you can see in our diverse panel, these experiences that we heard were heard across the globe, in Latin America, in Africa, in Asia, all over the world. The barriers are often interconnected, right? That's how it is in life, right? We kind of create a framework, but actually a lot of these barriers are interconnected. They reinforce one another, and they end up with the result of limiting or supporting IPS access, depending on whether they're enablers or barriers. Lastly, and this is something that Aidan mentioned already, these challenges for non-banks and fintechs to be plugging into IPS amplify challenges of serving low income and marginalized populations, because it is often fintechs and non-banks that are focused on those populations as end consumers and customers. Back to you, Sarah.
So thank you, Nandini. So what's really important to us is also to share a little bit of the methodology, because it's something that we thought long and hard about to make sure that we will be able to capture honest, true reflections across multiple markets. So our research actually covered more than 20 different jurisdictions, because one of the discussions in the Caribbean was a regional one. We touched Africa, Asia, and Latin America and the Caribbean with the focus groups. And we made sure that our focus groups were not too burdensome on our participants. So we kept to a 90-minute design, which included both time for discussion, which was the majority of the time, but also included the ability to complete an individual survey at the end to capture individual perspectives. 17 associations supported us to organise those focus group sessions, and we had 129 different contributors, 97 from fintechs and non-banks, some also for consultants and working in development sector during the conversations too, and there were 24 representatives from the 17 different associations as well. So you can clearly see it was the voice of the fintechs and the non-banks that we really wanted to hear in these discussions. And we started to touch on it, but just to be very clear, what we mean by fintech and non-bank, we mean those entities, things like non-bank payment service providers, microfinance organizations, neobanks. We also have included in that some of the smaller sized commercial banks, some of the smaller mobile money operators. We see it as being those who are not possibly market dominant. They can often also be called tier 2 and tier 3 providers, depending on where it is in the world that you have the terminology. Most will be licensed or on the process to becoming licensed, but maybe under tiered regulatory regimes, as many of the people that we spoke to were just providing payments and not necessarily other adjacencies, which is a really important point actually in one of the findings that we'll come to. As Nandini said, we didn't want to tackle regional payments. That is a whole new conversation, and I'm sure one we'd love to have at another time. But for this conversation, we focused solely on domestic instant payment systems, and very much only from the perspectives and experiences of fintechs and non-banks. We did not include IPS operators or central banks in our conversation because we had this very clear, sharp focus, because we felt that not many publications had been written on this topic from these particular voices. It was really important for us as well to make sure that we had key principles for this private sector engagement. And the reasons for this, I will happily explain with these 5 principles. So we really made sure that we co-designed with associations as strategic partners. This supports the contextual relevance, the fit, and includes sort of strengthening that participation as well. So the focus groups and our report, you'll all see, really does contain the logos of these partners, because we couldn't have done it and wouldn't have wanted to have done it without having them on board, because they certainly really helped the strength of the methodology. It was also really important to involve them as well, because what we want to do is generate long-term shared value and deepen relationships. We've already had 5 launch events held, 6, sorry, held about discussing about this particular topic that have really resonated. And it means that this conversation is going to be able to continue beyond just this webinar or just the assessment that we published. So that was very important for us to create value to the ecosystem and help the ecosystem's voices be heard both locally and globally. We ensured that there was complete confidentiality in the discussions, so people had a choice to opt to remain anonymous, and we have really tried not to include country names in our report unless it has been something very positive expressed, because we felt that it was really important that honesty and an open dialogue was key for us. Nandini and I both had the same methodology. We often facilitated together where that was possible, with time zones and other commitments. And that was really helping us with analytical rigor. And all the steps we took around confidentiality really helped us hear the authentic voice of the contributors. And having this discussion both created sort of a kind of a group consensus. It helped us understand whether key points were being made were just by one individual's experience or the whole group's experience. And we also then got to hear the individual perspectives through the comparable survey that we did, that made the insights more comparable across all the different markets and contexts. And so again, I just please draw your attention to all of the wonderful, vibrant coloured logos on this screen from our association partners, which also represent the amazing vibrancy, knowledge and expertise that also exists in the Alliance DFA membership, and we thank them very much.
Well, let's jump in on what we've discovered after our many months journey with the many amazing fintech associations and fintechs and non-banks that we met with. We're going to go deep dive into each of these key findings, but the top 5, as maybe you might have seen, Sarah and her team have done an amazing job on social media. 1, the economics need to work, right? That we heard that loud and clear from our stakeholders, that 0 plus 1 doesn't always equal 3, and very, very plainly said, especially when IPS mandates low or no cost payments to end consumers, while still requiring lots of costs to plug into a new IPS, fintechs and non-banks especially are struggling to make that math work. Second are what we call legacy policy issues. What you might already know is that our regulatory system is built for banks for the most part, right? And that makes sense. Banks have been around for hundreds of years, and our regulatory systems are built mostly around them. They're very legacy systems. But as we have seen the emergence in the last 50 years of fintechs, those legacy policy issues often gatekeep fintechs and non-banks. Third is IPS governance. Often focuses a bit more on stability, which is incredibly important, but also doesn't always balance that with inclusion. And what we mean by inclusion is inclusion to all financial service players rather than biasing potentially for more dominant players. Consumer-facing IPS literacy. We heard from almost every single market that this requires support, this requires guidance and centralized guidance. Lastly, hey, the uptime's got to be there, right? If you are a financial infrastructure and you want IPS, you want financial service providers to plug into you, the technology needs to be reliable and easy to plug into. Again, we'll deep dive into these in the next few minutes. Let's talk about the first one, the economics need to work. And Sarah and I placed this as number 1 because it was the number one thing that we heard from our stakeholders. If they could only choose one thing to say, I think this would be it, right? I'm not going to read this entire slide to you. You will find it as in our executive summary and in many of the social media posts that Sarah and her team have put forward. But IPS sustainability cannot just be dependent on transaction pricing, especially as you're seeing a push from some IPS for low and no cost payment, right? The economics of IPS, if they don't work, costs are going to be passed back down to end consumers. And that is going to be largely disproportionately affecting marginalized groups, right? And so where you see often in an IPS, you cannot be a direct participant into the IPS. You might be reliant on a direct participant. That direct participant will also charge for participation. And so that creates a middleman or a middle person, right? And so you can see in the quotes, this is one of the things that I think is so rich about the report. If you don't read the report, it's okay, but skim through it and read our quotes, because that's from our fintech associations, fintechs and fintech associations. They talk about their third parties break the business model of fintech. Sometimes they make it financially unsustainable because of the costs. It's expensive for fintechs to serve their consumers. Where organizations have been able to directly participate, it's been more efficient financially for that fintech. And maybe it's okay to have sponsors, maybe it's okay to have middlemen, but maybe be more clear, define those sponsorship rules, make them transparent, cap pricing by sponsor institutions were some of the recommendations made. And I think those are really powerful statements to hear. So first and foremost, what we are hearing for many players is that plugging into IPS, especially as an indirect participant, often doesn't economically make sense. The business model doesn't make sense for them, and therefore they're losing money and or having to pass on those costs to consumers. Sarah, anything else to add that I haven't mentioned you want to make sure we emphasize here?
No, great. I think, we'll hear from the next ones how interconnected they are, because cost does come up in almost every single one of the findings. So great job, Nandini.
Thank you so much. Secondly, I mentioned this, and Sarah and I think this is an important and maybe a unique perspective you don't hear much from others. But definitely, again, we've placed it as second because if they could only say two things, I think it would be these two things. These legacy policy issues, right? If our regulatory regime in the world and in the countries we work in is based on regulating banks, right? And then others potentially as a secondary set of institutions, especially potentially dominant players might get more attention. Then it is the fintechs and the non-banks, as Sarah defined them earlier in our deck, that kind of face the challenges and the ramifications of those legacy policy issues. And often they gatekeep fintechs and non-banks. What does that mean? It means if at the very basic level you can't get licensed, or it's very costly to get licensed, or it takes a long time to get licensed, and if being licensed is a prerequisite to joining an IPS, then all of these legacy policy issues that create a slow track, not a fast track, for fintechs and non-banks to join IPS, then create an additional set of barriers that don't even have to do with the IPS, right? They all have to do with the existing policy systems. So you can see some of the barriers: lengthy procedures, high capitalization requirements that are not always proportional, uneven access conditions, and sometimes a bit of fragmented regulatory approaches, right? Robust regulation is essential to safeguard monetary stability and stability of the IPS. So I don't think Sarah and I have any issue with robust regulation. I think what we are hearing is, though, if it can be proportionate, right, to the risk that a fintech or a non-bank represents, that then can actually potentially release and increase competition innovation, right? Where we've seen things work, right, where there's clear participation pathways, we see risk-based regulatory requirements, we see central bank support, right, where they're communicating, hearing from fintechs and non-banks and actually making adjustments. We heard that from many markets. Hey, our central bank listens to us. And that was amazing. And lastly, what we love seeing and we hope we see more of, and I know African Enda has done some work and highlighting this as well, license passporting for fintechs. We heard lots of positive things around that from our fintechs. I love the quotes again. Technically, we are ready, but regulatory-wise, we are not. Payment regulation in many jurisdictions was originally designed for traditional banking systems, this is what we said, and hasn't yet fully adapted to fintech and non-bank models, right? And lastly, regulators and policymakers can support all FSP's participation in IPS by providing clear and predictable participation pathways, right? Again, if you don't read our report, it's okay, but read the quotes. They're so good. Back to you, Sarah, for the next finding, please.
Thank you so much, Nandini. And this was another really important topic that came out is the concept of the governance and rules and how the IPS operates now, and also how it is planning to evolve and change for the future. Because as we know, technology never stays the same. It's already old today for tomorrow's future. And the governance arrangements are a really important and significant determination of how fintechs and non-banks can participate in instant payment systems. And so, as we've said, there is a lot of legacy systems in place and legacy policy in place. And sometimes these are brought into the instant payment systems, which creates a more bank-orientated system and designer rules that work for banks more than other players. There's also sometimes a structural imbalance in the representation and decision making that happens. So, direct players who are often the banks, sometimes the mobile money operators as well, they often have a seat at a forum because they are a direct player. But the fintechs being indirect through these sponsor institutions, these banks, don't have the same seat at the table. And what that means is sometimes the needs and the requirements of fintechs and non-banks are just not heard, and the design of the system does not enable them to build. And I think there's one quote here that is so important for us to reflect on. Rules and governance change the magnitude and type of products and services that can be built on the rails. And we know that everybody, or many countries of the world, have national financial inclusion strategies and are actively pursuing keeping money digitally and making as many different use cases as possible for transacting and utilizing and saving money, e-money rather than the cash in, cash out. But actually, the design of and the governance and the rules of your instant payment system, if not designed to also include fintechs and non-banks, that does limit what can be built on the rails. We've heard as well, I think another really great quote was, "This is governance wearing a cloak of technology." So we think, oh, it's challenging because of the technology and the APIs aren't working, and we have excuses. But ultimately, sometimes it's just about making sure that there is structured, responsive, and dedicated engagement with fintechs and non-banks, whether they are direct partners or indirect partners. There needs to be this sort of clear rules to the scheme as well. So transparent system reporting processes, and also for consumers, clear scheme level dispute resolution frameworks. We heard from some fintechs and non-banks that when one of their customers has an issue, it can take a long time to resolve, to find out where that money has gone, because it's not really clear what has to be provided and how these sort of challenges to the system with customer complaints are meant to be handled. So we really are advocating that the voice of fintechs and non-banks are heard and meaningfully heard in the way that the IPS is structured, it designs, operates, and its future vision as well. Nandini, back to you to talk about the consumer side of things.
Sarah knows I have a lot to say about this one. What we heard from almost every market was that IPS awareness and literacy are not downstream communication challenges, but actually a core design principle, right? What we have seen in markets like India and Brazil and a few other markets where central banks or the owners of the IPS have given scheme level guidance on using branding guidelines mostly, it really helps create a coherent consumer experience where they know how to access the IPS for the services that they need, right? And in many markets, even those IPS operators or central banks have taken on communication campaigns to better understand for consumers what the IPS is, right? And this really optimizes profitability for the whole financial ecosystem, right? But on the flip side, when it isn't happening, which is most markets we interviewed, this is not the norm, right? The most important thing is to get the IPS running, right? But they haven't necessarily thought or put forward branding requirements. You are seeing inconsistent branding and user experiences at the minimum, fragmented onboarding journeys, and sometimes, in the worst case, you are seeing actually hidden or hidden patterns, right? Where some fintechs, some banks are choosing, because there is no branding guideline and they can kind of do whatever they want, they put the more expensive version of the payment product or the payment service in front of the user behind it, or almost hidden, is the actual free or low cost IPS, right? So, it's very important around just creating those branding and marketing guidelines, ensuring user experience already integrates, financial education around what this IPS looks like, and even other more extended financial capability opportunities. Back to you, Sarah.
And so obviously technology has to be one of our key findings. IPS, after all, is technology. And one of the things that we sort of heard is the reliability and availability of the IPS are the key coefficients as to whether fintechs and non-banks can and want to and will participate in the instant payment system. What we heard from one market is someone said, oh, we have about 99% of uptime of our IPS. It's unreliable for 1% of the time. And at first you think that sounds like quite good figures, until you realize how many thousands of transactions that 1% represents, how many thousands of consumers without access to their funds that 1% meets. And nothing in the world can ever be 100%, but we need instant payment systems that are 99.9% reliable. Because otherwise you're forced to have alternative arrangements to deal with that time when the IPS is down. And that further additionally adds to that cost barrier that we spoke about too. There's also, in our world now, connecting should be really easy. It should be like, plugging a socket into an electricity connector with a little bit of, work around that. But the effort should be minimal, because we should have things like standardized APIs, clear and well-documented procedures on how you plug in and access. There are internationally recognized standards now for harmonized messaging standards, yet these are still not being used in some of the countries, and the different payment messaging standards creates additional technology burdens. Really what is required are defined integration and onboarding and support processes to be able to make sure that the ease of access and the efficiency and reduced cost of being able to, whether you're direct or indirect, all of these things can be done. Establishing things like technical checklists, pre-certified integration environments, parallel approval workflows would reduce the delays and integration costs for fintechs and non-banks. And I think that is a really important, message to remember, because ultimately we want fintechs and non-banks and payment service providers to want to use the IPS. We want to make them want to, sort of pull. We don't want to push the IPS. And adoption by all financial service providers is required in the market for an IPS to become sustainable and functional for the market. And it's expensive to invest in the technology and the specialized staffing, and that is creating a significant barrier for fintechs and non-banks, as well as adding to that cost. And you can see why cost was number one for us here, because if you think about the cost of delays for waiting for registration and things like that, and the cost of sort of capitalization, you look at the cost of technology, the cost to acquire consumers and educate your consumers, the cost of maybe having to participate indirectly in the IPS. All of these are extra costs that layer into that already potentially small margin that fintechs and non-banks are making on their products and services. And really that's why, as a reflection for me, why that making the maths work, making the economics work is really the number one finding of our report. But I'm going to hand over to Nandini, who's going to also share some of the other really important personal reflections that we made during this process. Oops, there we are. Eventually I'll get the right slide.
All right. I know that we are a little going over on time, Sarah. Are we okay? Because I know we had a couple changes. Okay,
We'll
great.
do it really quick.
We want beyond what you've read in the report, beyond maybe, what you see on the slides and social media, we wanted to give you these 5, this is what surprised us. This is what was, insightful for us, right? I think we came into it not really knowing can you be an indirect participant, right? When you go into an IPS as a financial service provider, you're either a direct participant or you're an indirect participant. We kind of came into the idea, can you be an indirect participant and still have a positive experience? And our colleague in Ghana will talk about this, but we've had a couple markets, especially Ghana and Indonesia, I think it was, Sarah, where indirect participants were happy. They were like, this is great. Central bank has done a great job. IPS has done a great job. We're communicated with. There's a WhatsApp group where we're part of, and they talk to us. And so indirect participation can work if it's clear, is communicated well, there's clear communication lines, and governance is clear, it can work. So that was a surprise to us, I think, maybe. First and second, zero cost payments, what we heard from some of the more advanced markets, India and Pakistan, was, hey, zero cost payments have actually done an amazing job helping us acquire customers, individual customers and merchant as customers. But what happens next, right? Like right now we're receiving subsidies to make all of this work. How do we make money in the future? Of course, we have to do value-added services, but also can we look at merchant discount rate? Can we look at data monetization, which has its own issues around data privacy? So I think if you're going to go zero cost, I think down the line, you have to figure out how will fintechs and non-banks make money? And if you can integrate that into the design and the discussions, I think that'll be really helpful. Access to IPS can be transformational. We heard this saying, right, Sarah? Day and night. It was repeated, that saying, across a few different markets when a organization was a indirect participant, let's say in one time period, and then they transitioned, they found enough capital, or they had enough strength in their business model where they could become direct participants. It was a night and day experience. So what we did here is being a direct participant has a lot of value most of the time. Consumer branding experience is overlooked. We kind of talked about that a lot, but I didn't want that to go away. That's really important. I think if you're thinking about how to design or advocate for a really strong IPS, it shouldn't all fall on FSPs to be advancing consumer education, and consumer branding can bring you a long way. Lastly, I got the sense, I've been working on IPS related issues for a long time, and there's a build it and they will come mentality. And I think Sarah and I discovered they don't always come, right? If the uptime isn't there, if the math doesn't work, it's very difficult to plug in and make it all make sense. So I don't think you can start and end with a build it and they will come mentality. Back to you, Sarah.
So I think I'm going to save my last slide for the conclusion so that we can actually get into our panel discussion a little bit quicker and hear insights from the market. So we've got wonderful insights that we're going to hear from Chile, from Ghana, from the Philippines and South Africa. So let's welcome our 4 panelists. And Constantia, I'm going to start by asking you, a relatively open question, from the report and from our presentation even. What really resonated with you and your market?
Thank you. Thank you, Sarah. First and foremost, I really wanted to thank the Alliance FDA, Contigo Global, and Interledger Foundation for having me here, as well as Fintech Chile, and of course, Pronto Paga. Answering straightforward your question, the whole investigation was quite impressive for me because I thought the different results were going to be more segregated or isolated, depending on the province or the part of the world where it was coming from. But it was quite impressive to see that we were quite aligned. Also, what really resonated for me, and is one of the findings that it's kind of present in several of the 5 key findings, it's the dependency. That is something we have personally suffered in several of the different countries along Latam where we are present. So I think that's something we have to really dive deep into and analyze it. And a third, I was kind of thinking that the moment where this whole investigation is coming, it's quite perfect, because what is happening now in LATAM is that the vast majority of the countries still do not have a IPS system, like the definition that Nandini was clearly pointing out. Even though we have fast payments, even really close to instant, we do not have the structure in the vast majority of the countries. So the moment where all this investigation and all these findings are coming, it's really it's quite perfect again.
Well, that's it. That's amazing to hear that maybe we are at the right time to help prevent some going down a path that maybe isn't so inclusive, and we can direct to going down to a more inclusive pathway. Danielle, I'd like to bring you in here and ask you the same thing. Sort of, does this resonate with the South African ecosystem and with FNASA?
Yes, absolutely. I think the reality of the situation is that building a rail, so to say, is only the beginning. The fact that there is inclusive design means exactly what it says, right? That we're creating this level playing field so that banks and fintechs and other providers can contribute to, at the end of the day, or with the end goal, reach those underserved community. Now, I think what comes next, and this was even quite obvious in the report, is next is governance, next is sustainable economics, and probably the most important would be trust. I'd say narrower, the trust is the final frontier, so to speak, because as we've heard and we've seen not only in this conversation, but many across specifically the continent here, is that access matters for sure. And it looks like we're moving forward in, a good way and a fast way. But if people don't trust the system, inclusion won't follow. And by that very definition, access actually doesn't matter. So overall, I think the findings are great. I think the way forward is really positive, but quite honestly, there's still quite a lot of work to be done.
I love the phrase that you use, the level playing field. That is very much what we need to keep driving towards, to create that level playing field, and then the follow on from that, the consumer trust, a critical element. Ariane, I'm going to bring you into the conversation now. Really, I want to hear a little bit more from you about that first finding, the economics need to work. So from your perspective, how does the IPS and the regulatory architecture impact on costs for the fintechs and non-banks?
Extremely significant. And I think the presentation of yourself, Sarah, and Nandina is perfect, really refers to the pathway to profitability. I think that fintechs and non-banks especially are looking to prove that financial inclusion, whether that just means access, agency, or control, is not just a sustainable business model, but also a social good. And in order to prove that out, the economics, as you say, need to work. So what is happening with architecture? It's all about costs. First, cost of access. Second, cost of compliance. And third, cost to the consumer. So with the first one, I think you've explained it very, very well. Many of the fintechs and non-banks need to pay a middleman tends to be a monopoly, a very dominant bank or operator of payment system in order to access the national rail. And this creates not just costs with respect to revenue-based sharing, but also sometimes liquidity issues. So in order to join, you might be asked to pay a down payment or put certain reserves on the side, and that is not available to every fintech. Especially in the Philippines, microfinance institutions, which tend to focus on regional or small geographic locations, they will not be able to meet this type of the demands of these dominant players. So second, it would also be cost of compliance, not just to the requirements set by the middleman banks, but also the central banks. And I think this would usually include what was referred to earlier, the zero cost or low cost model. In the Philippines, for instance, the central bank has been pushing for zero transaction fees, which many banks and non-banks have said is just not feasible. The cost to build the system, which is not subsidized by the government, the cost of operating it, the cost of educating the population to adapting to the national rail system is very high. Other than that, a lot of the central bank, in fact, has said that what they want with a recent circular is for electronic payments to always cost less than a physical or bank transactions. So this also makes it very difficult for fintechs to encourage their consumers or people they wish to target to adopt electronic transaction payments when they know that they're absorbing the cost. So that really creates an impact for financial inclusion. And finally, I think it's really cost to the consumer. I probably take it up later in this discussion, but the cost of educating the consumer to understand what the national payment system is, how to use it, how to choose the best price and the best service is very high. And that has to be absorbed by the fintechs. And it is really, I think the report also alludes to it, the last mile is the fintech. So the banks are creating the policy, or the central banks are creating policy to focus on banks, but the people who are implementing it will be fintechs, microfinance institutions who aren't given enough tools and resources to do so. So very difficult, I think, to make the economics work when fintechs and non-banks don't have, as I think it was Danielle said, a level playing field to shape the policy.
Thank you so much, Ariane. It's a really good reminder of all of the different costs, some feeling hidden as well, that exist for fintechs. And Celeste, I'm going to bring you in and ask you, what can we do to support these economics to work, viable business models and growth for fintechs and non-banks?
Well, can you hear me?
Yes.
Okay, great. All right. So I think what has been the experience in the Ghana case has been that we enabled interoperability, and then in the process, we created an enabling regulatory environment with strong digital infrastructure, right? And then there is a broad-based ecosystem partnership, which is what is driving the growth of the IPS system in Ghana today. And what I've also seen is gradually the partnership between the banks and the fintech is creating an uptake, but also creating a room where the margins are also thinning, because then the banks would have to share the revenue with the fintechs, right? And the banks always get a bigger share of the revenue. The fintechs get a small portion. And then now there's no motivation to keep innovating, right? So we need to find a way to create a clear balance between how the fintechs and the banks can work together, in a way that makes meaning for both parties, right? And also not create an expensive product for the consumer. So in my opinion, that is the only time that we can see the growth of IPS in Ghana, and then also, boost financial inclusion in the long term.
Thank you very much, Celeste. Yeah, those margins are fine, and we need to find ways to support them. And just to remember as well, just for anyone listening, we're not talking about fintechs becoming, multi-billion-dollar unicorns. We're actually just talking about fintechs, being able to make enough profitability to stay open, to sort of grow and be able to innovate in the space. So it doesn't mean that doesn't necessarily look like, a very expensive thing. It is just about having the right margins to incentivize to continue to want to do this work. I'm going to swap and talk a little bit now about the legacy policy issues that are in market. And Constantia, this one is coming to you. In your market, do you feel like regulatory requirements are proportionate to the risks that non-banks and fintechs actually present?
This is actually a great question. I think that it clearly depends on the jurisdiction. I kind of have a scope of the whole LATAM area, but what I have seen and the study clearly pointed out is that the regulations and the laws have been made by banks for banks, and then they have extended to non-banks and fintech and other intermediates during the whole ecosystem, through the ecosystem. So here the risks are not always distributed in the best or in a proportionate way. I'm not saying that we need less regulation. I'm saying that smarter regulation is better. And because when we have excessive regulation, then we or the country, the market, does not have innovation. And finally, what we want is to have a safer ecosystem, faster ecosystem, and something that can reach to everyone. So just point forward answering your question, I have seen that as we have inherited this legacy, as you said in the study, is not the best for the moment we're living through the region, and it should be adapted to the new requirements. What I have usually seen, and several of my colleagues are kind of suffering the same, is that the central banks or the regulators are kind of learning with us, through us. So we kind of need this extra push, this extra effort to have the risks more evenly distributed between the different players, and even more to the new players that are coming in the several years that we can see really close.
Thank you, Constantia. I love the word hereditary. We must make sure that we're taking the good things, but also allowing space for the new things, especially as technology advances so quickly. And Danielle, I'm going to bring you back in here because South Africa is making some challenges. We are seeing some changes to the regulations and to how payment systems are working in South Africa. Maybe you could sort of share, some of what is going on there and how this will help.
Yeah, so I think you're right. South Africa provides some interesting examples. So beyond the regulatory sandboxing and creation of intergovernmental fintech working groups, there is a massive amount of support from the Reserve Bank for broader participation. We're seeing strategic shifts here, and even requirements coming out of the regulator that puts a significant amount of pressure on a proportion of payments running over domestic rails. And effectively what that does, it positions a business like Pay Inc. not as a payment company that only operates an instant payment system like PayShop, but as a national payment utility that is being nurtured by a Reserve Bank. And I think it's significant because, like I said before, we're not only talking about access here, but we're also talking about resilience, we're talking about sovereignty. And, if you're building a strong domestic infrastructure with a strong national payments utility, then it reduces the reliance on global schemes over which a lot of countries have a lot of, limited regulatory control. It also creates a platform for that broader participation and innovation. So, I don't think that the South African Reserve Bank or anyone within our payment space, including the banks, are kind of shutting down to the fact that non-bank participation needs to be, high on the list of the regulators' things to take note of or to include. Um, I think everyone understands that it's huge for South Africa because it really opens the whole system up to innovation without carrying this very broad risk of lack of regulation and consumer protection. So the question is actually when we're talking about the future of payments, the regulation, what that should look like, the government structure, what could non-banks, who are the pioneers of financial innovation, right, and digital technology, what could they do with access to a trusted and balanced IPS, and if we think on that for a minute, we can do a lot. With the regulator taking that in mind and being really forward thinking with regards to innovation, I think, the sky's the limit, which is great.
Thank you, Danielle. It's so important to have a regulator that is championing fintechs and non-banks, and that's when we're beginning to see things change. And we're delighted to see how things progress in South Africa, and we'll very much look forward to that through a case study. And talking of champions, Selassie, I want to bring you in here because when we were talking about governance and IPS operators in Ghana, we really heard that GIPS were communicating well and involving non-banks and fintechs in many of the conversations that we're having. So please tell us a little bit more about whether, how fintechs and non-banks are feeling about having a voice in the instant payment system design and decision making.
Right. Okay. So I think what is working here is that collectively, the fintech companies, they have a meaningful voice within GIPS. We are becoming increasingly important for decision making because we innovate a lot. We are the one driving the digital solution space, right? However, we have limited powers, if I can use that word, because of the way the system is structured. We don't go to GIPS directly. We have to go through an intermediary, a bank, and that takes a lot of power away from us, but we continue to remain a strategic, and operational decision makers for GIPS. And, I think over time, we've managed to influence policy, in that regard. But I think if we can work on that power dynamics, the direct and indirect bit, that would actually boost the way fintechs play in the space and make a stronger input, the way the banks also make them.
That kind of two-tier power imbalance really came through a lot in our conversations, and I'm glad you brought that up. And maybe Ariane, I can bring you in here. So what does good governance look like from a fintech and a non-bank? What would help kind of even out that power balance?
I think it sounds like South Africa is what good governance sounds like. And with Ghana on the way, it's really about having an equal opportunity between banks and non-banks and fintechs to shape the policy, just to have that open communication, collaboration with the regulators. I think that's what every country should be aiming for in terms of once you've reached that goal, what would it look like? I think number one, equal enforcement, regardless of the player of different schemes. I think, for instance, the Philippines, one of the largest banks, just recently had a 48-hour downtime. So that meant that fintechs, retail, apps were not able to access the national rail system through that bank for 48 hours. And that has a ripple effect, especially with debt, with credit, payments being made. And the question is, of course, is whether or not the regulator will be enforcing any rules equally, especially against the biggest bank of the Philippines. So it's really about making sure there's accountability for failed and delayed transactions. I think that's the bare minimum that we should do for fintechs and for the consumers. I also think that good governance means that as there's more conversation and collaboration, we're also changing the legal framework from the bank-centric to the consumer-centric. And that means standardizing requirements, making sure that there's procedural transparency when you're trying to resolve dispute resolution mechanisms for consumers, jurisdictional issues. In the Philippines, at least, we have 2 or more regulators for different types of financial players, yet the national payment system rules are dominated or set by only one. So I think making sure, whether it's in the Philippines or the rest of Southeast Asia and the world, that these rules are standardized so that it's very easy to comply, reduce your friction with respect to uncertainty of rules, applicability of rules. I also do think that there is an opportunity to make sure that whatever requirements are set by the regulator, they are also risk-based and proportionate. Fintechs, especially those with smaller capitalizations or smaller or localized markets, should not be required to meet the standards of both licensing and supervision of banks, which have, the highest degree of fiduciary duty to the customers. So I think good governance is basically equal opportunity, equal enforcement, and hopefully equal benefit to the consumers, regardless of which player they're working with.
That equality, that level playing field is just such an important point. Thank you for making that, Ariane. And you started talking about consumers, and let's stay on that topic. How much do you think consumers are aware of IPS in your market and others that you may know? Is there lots of knowledge, or is there a gap?
I think consumer awareness is very low, but that is natural because IPS was created and envisioned as back-end infrastructure. It was intended to be invisible, but we're also seeing the issues created by that invisibility. So I think the report mentions dark patterns where dominant players will hide lower priced rails or lower priced channels of access, or prioritize those which have higher transaction fees and benefits them most. So that's dangerous. Or you could even have nothing motivated by self-interest. It's just a lot of players, for instance, in the Philippines will organize different access channels by alphabetically. So when you have, let's say, 50, 100, it's very difficult for a consumer to go all the way down and sort of like shop the best price. They'll just go for the brand that they know of or that's first on the list. So there's a lot of issues for consumers when they look at different applications, the logos, the names, even the user interface is different. It creates a lot of confusion for them, which is why in the report, I was really glad to hear that there are these design standard schemes. I think it was in Brazil and India, where the regulator is able to say, okay, this is how your brand, your marketing should look, to sort of provide that additional level of financial literacy or like a handicap for consumers. I think that in Southeast Asia, we would definitely appreciate that. And we should also create incentives, I believe, for fintechs to show the cheapest rate or lowest transaction fee to consumers. And at least in my company, we did that to a great extent. I think there's also the issue of confusion when a dominant player is the first company to provide access to the IPS, then the brand becomes synonymous with the IPS itself. It's like when you say, oh, we search, we Google. So that means that many people do not have the understanding that they have different ways of accessing that rail system instead of the dominant brand. So I do think there's a lot of opportunity and there needs to be investment from both the public sector and the private sector to consumer literacy.
Amazing points, Ariane. That cognitive load that sometimes we put onto consumers is too high, and we need to find ways in which to create better awareness. And so Constantia, and I'm just going to quickly say to all panelists, we're overrunning a little bit, so if we could keep our responses as short as we can. There's so much to say, but Constantia, coming to you, who is responsible for IPS awareness? Is it the fintech? Is it the IPS operator? Is it the central bank? Whose responsibility do you feel it is?
I think it's for sure a shared responsibility. So I just wanted to share with the audience that a couple of days ago, DLA Piper invited several members of the FinTech Chile Association to just this really nice breakfast where we were speaking about all the findings in this study. And this was one of the key points we mentioned. And we spoke about how was the experience in Chile when the public card system, Transbank, was came into the market. This happened at late 90s, at the beginning of the 2000s. And here the awareness was fully trespassed to the private sector. So they had these huge marketing investments. And of course, it wasn't it was the tools they had at the moment. But right now we're at 2026. And we have so many more tools than back at the 90s. So I think it should be shared. I think the government has a responsibility, huge responsibility. It has to legislate with awareness, with a risk-based criteria, but also the private sector can reach the audience, as Ariane was really clearly specifying right now, and we should share this burden together.
Absolutely. I think that there are some things that can be done by the providers, some things that need to be done collectively across the entire market. And you talked about we're now in 2026, and it transitions us really nicely into my next question to you, because we're in a world where we're more technologically advanced than ever, yet we are still having difficulties with integrating to the instant payment system. And in particular, I'm going to talk about that rather than necessarily the reliability, but what are those barriers, and what are the impacts of those barriers?
This is again a really good question, because it's so technological. How can we not be part of this technology? I'm not a programmer, I'm a lawyer, but there's several things I have investigated. I know that just connecting to the API or the API access can be quite inconsistent. Several technical requirements can vary depending on the participant, and that also can be quite complex. But finally and foremost, it has to be one of the points we have talked with several panelists, and it has to be the costs. Even though we say we have the technology, really putting it in practice can be really, really costly. Just think about separating the environments, having a business continuity plan that works with the technology. That is not cheap. It happened to our company that from one day to another, we were regulated. The regulator simply changed its criteria, and we had to get on board or get out. And thankfully, we already had that development stage. We were big enough in order to have the resources in order to implement all these things. But a smaller company, a just startup, a small fintech does not have all those tools, all those resources. So final and foremost, I think the greatest barrier here are the costs. Whenever the regulator is not aware of the reality, and that has to be the greatest challenge, even though we have the technology.
Yes, very clearly, loudly, well said, Constantia. Thank you so much. And let me come to Danielle, and I'm going to make this the last question for our panel, because we really also want to hear from Halti and Nandini as well, to reflect on what this might mean globally. So Danielle, coming to you, we are in 2026, the technology exists. What improvements do we need to make participation easier and more affordable?
Sarah, look, I'm really appreciative of time, and I don't want to repeat what the other panelists have said. At the very face value of it, I'm not a technological expert, so I'm unfortunately not geared enough to tell you what technical improvements we need. What I can say is exactly what has been said already, very briefly, is that it's probably less about technology and it's more about reducing friction. So if we have a faster onboarding process or clearer rules, or focus on making it easier and more affordable for smaller players to participate, then we can facilitate a bigger impact. I think, speaking from a purely South African perspective, our regulators are super well informed as to what the costs and the risks are. and focusing very heavily on making sure that regulation is inclusive. When you have regulators that are starting to talk about innovation first and foremost in any of the papers that they send out, then you kind of know that you're dealing with someone or dealing with people here that really want to help make participation easier. And I'm not sure that that's a technological solution. I honestly think that exactly what the panel members have said about inclusivity from a smaller player perspective is what we need to move forward.
Thanks, Jenny. It reminds me of that quote that we had on the deck. It's not always technology. Sometimes it's technology wearing a cloak of governance. And maybe that's a good way to reflect back on some of those challenges there. I'm going to stop our panel discussion and going to say thank you so much, Ariane, Danielle, Selassie, and Constantia. Thank you for bringing to life some of the findings that Nandini and I shared earlier. And now we're going to move into sort of a little bit more of a global reflection on the study. We are really delighted to have the World Bank, and although not here, we have a statement from Africa Nenda, as Jacqueline unfortunately is unwell. We've been working with them, Nandini and I, to do another publication as well. We supported their paper, Scaling Instant Payments in Africa, Policy Choices for Central Banks. So it's great to have panelists who share our passion for this topic of inclusion. And I'm going to stop talking and pass over to you, Nandini.
Thank you so much. Holti, a pleasure to have you. It's going to be a little bit more of a conversation between you and I, which I think can be really nice. Holti, you've been in this space for a long time. Holti is the kind of person, I know in our previous assessment that we worked with Holti, Africa Nenda, the Benefit Cash Alliance, and their monetary fund, has very detailed feedback and questions about insights. And so I'm curious, Holti, my first question to you is, we have 5 themes that we talked about, right? Like the economics don't work, legacy gatekeeping issues around policy, et cetera. How do these findings potentially align or not align with what you're seeing from the World Bank perspective?
Yeah, thank you very much for having me. And I think the previous speakers pointed to a lot of the sort of the themes that we are also seeing around the world, and indeed reinforced to a large extent, I think, the sort of the findings reflected on the paper that was recently published. But I would say the bigger picture matters, right? So in other words, it's obviously necessary to have a modern, interoperable, fast payment system. And just to pause here very quickly, I'm going to use the term fast instead of instant payments. At the World Bank, we use the CPMI terminology, but in terms of substance, we're talking about the same thing. So yes, I mean it's obviously it's important to have that fast payment underlying infrastructure, but it's a necessary but not sufficient conditions, right? So you need the enabling environment to give the chance to the fast payment system to succeed. That means, and again, I'm gonna repeat a little bit some of the elements that were already mentioned, but obviously a legal regulatory framework that creates the level playing field that we've been talking about for the banks and non-banks to collaborate, but also compete in a healthy way with each other. It's very important to have a comprehensive consumer protection framework in place, especially when it comes to fraud, cybersecurity, dispute resolution, be it between end users or payment service providers. We talked about inclusive governance mechanism, balanced pricing. And in all of this, right, let me reiterate the important role of the central bank because of its multiple roles, right? As a regulator, overseer, catalyst, and operator in many cases. But it does need to engage the private sector early on, right? Both banks and non-banks in order to kind of collectively, right, shape up the design that is very much then tied to the broader national payments modernization strategy, right? So everyone is indeed, I think, sharing the vision, right, at the end of the day, for a particular country jurisdiction. So just kind of to set up the scene a little bit from my side.
Thank you, Holti. Is there anything from our report that surprised you? Like, I mean, you're a global expert. You're looking at it from multiple markets, just like we are. You are very deep in the fast payment system space. Anything surprise you?
Not necessarily. I mean, one has to say that progress has been made, right? Despite the fact that the challenges remain, especially when it comes to, non-bank payment service providers. Um, I would also agree that it's not about technology anymore, right? So we are seeing more and more that technology-related costs coming down, be it, at the payment system level itself or at the PSP level, right? Connecting. Again, it's I think it's more about ensuring that the rules, the regulations, the systems do not have any sort of policy barriers when it comes to non-bank PSPs accessing those systems. And it's not about forcing non-bank PSPs to access directly, right? Rather, you are removing the barriers and then you're leaving it up to the PSPs, right? And especially non-banks, if they want to connect directly or not, right? It could be the case, and I think the point was mentioned before that some might actually choose a different an indirect path, and that's fine, right? It might make sense, it might make economic or technology sense, whatever it is for them. I think we should also, again, really hammer on the point of the regulator engaging, very early on and making sure that the voices of the non-banks are reflected. And in that context, as a World Bank, we've actually been supporting for years now central banks to put together fora such as national payments councils, national payments committees, right, which precisely bring together all the relevant stakeholders, including non-banks, to make sure that from the very beginning, right, their interests are represented, and whatever strategies are being discussed will have their inputs incorporated, and also on the governance, right? So for us as a World Bank, it's not so much about the ownership model of the fast payment system, right? We are seeing that there is different ownership models there, and they don't necessarily determine success. Rather, it's about governance, and again, it was mentioned, right? So ensuring that the governance structure mechanism is also inclusive. And again, there is different sort of practical ways to achieve it. In many cases, the central banks have appointed independent board members or members again of the broader sort of payments community to precisely also reflect voices and interests of those actors that are not necessarily direct owners. So again, I think very much what we are seeing aligns also with your findings. I think it's important for us now acknowledging, of course, progress, but focusing precisely on those issues and challenges that remain, which I agree. It's about, again, the broader enabling environment and ensuring that that enabling environment is also conducive for the non-bank PSPs to come in and thrive.
Okay. I am going to ask you a little bit about that first finding and your reflections, the World Bank reflections on that. But before, I want to give you a moment to pause. It made you talk a lot. And Sarah, why don't I invite you to share feedback? And I know we've had so much good support from Africanenda, and we've referenced them. Many of their sort of points of reference have been to Africanenda in our report. Could you share with us a little bit what I know Jacqueline couldn't join us, unfortunately, wasn't well, but maybe her statement of intention here.
Sure, let me read this out on Jacqueline's behalf. And apologies if it sounds a bit stilted. I'm trying to read from the script that Jacqueline has shared. She has lost her voice, so that is why she's literally not able to speak at today's session. But she really regrets that she's not able to join live. But I was grateful that her voice can still be part of this discussion. The Africanenda SIPS 2025 work shows that Africa's instant payment systems are no longer pilots. They are now critical components of digital public infrastructure, with 36 live systems across 31 countries and most transactions already flowing through cross-domain schemes that on paper should be open to banks, MNOs, fintechs, and other non-banks alike. Yet this research on questioning IPS design inclusivity really has reminded us that design choices in access, pricing, and governance are quietly determining who can participate meaningfully and who is left standing at the door of these systems. Across Africa, non-bank providers describe a common reality. Even where IPS participation is technically open to non-banks, access models remain bank-centric. Integration support is limited, and governance fora are dominated by incumbents. This means that the very actors best positioned to reach women, youth, informal workers, and last-mile communities are often treated as add-ons to infrastructure that was not designed with their risks, capital constraints, or business models in mind. The SIP's research inclusivity lens is clear. Inclusivity is not just about who is connected, but who has design input and governance voice. Whether non-banks cannot shape scheme rules, dispute frameworks, access tiers, or onboarding requirements, we should not be surprised that IPS functionality, pricing, and risk allocation often mirror legacy hierarchies, rather than the needs of a cash-first users or micro-entrepreneurs. In other words, we have built fast systems, but not yet fair systems. This assessment pushes us to ask harder questions about instant payment systems as digital public infrastructure. Who sets the rules? Who bears the compliance burden? Whose data are prioritized in risk models? Their work underlines that exclusion from governance and opaque access frameworks are not abstract issues. They translate directly into higher costs, slower innovation, and missed inclusion outcomes for the very communities IPS are meant to serve. So the opportunity and the challenge for schema operators and regulators is to move from inviting non-banks to connect to hardwiring them into the center of IPS decision-making. That means reserving formal seats for non-banks and their association in IPS boards and technical committees, co-designing access and settlement models that reflect the capital and risk realities of smaller players, and publishing transparent, proportionate access frameworks that do not require a bank sponsor as the de facto gatekeeper. It also means resourcing fintech associations so that they can bring structured evidence into consultation, not just episodic anecdotes. The question that Jacqueline would like to leave you all with is this: if we mapped power, not just connections, across your instant payment systems, where would non-banks sit? At the edge as users, halfway in as connectors, or at the center as co-architects of rules, risk, and rewards? Until our answer is at the center, we will continue to digitize old hierarchies at real-time speed, and we will call that inclusion.
Sarah, I know that we're closing on time, so I'm gonna maybe have one more question for Holti and then pass it back to you. Does that work? Great. Holti, number one finding is the economics have to work, right? And we heard from everyone from very advanced markets like India and Pakistan to, kind of incumbent markets to IPS, that's sort of one of the biggest concerns and or challenges to existing systems. What's your perspective, World Bank's perspective on sort of the economic model, right? The financial model of sort of, what you pay for the infrastructure as an FSP, how you get paid, through the infrastructure, and then through however you choose to engage with consumers. Are those economic models making sense? Does there need to be a focus on a better way of plugging in the numbers and making sure they work in the long term, especially if there is a push for low and no cost payments? What's your take on that?
Yeah. I think there's obviously different layers, right, to this question. What we are seeing is that most fast payment systems work on a cost recovery basis. So obviously at the very least, right, you need to be able to, cover those, those costs in order to, be sustainable. Now, of course, when it comes to the initial implementation, there's different kind of, models of how those money and those funds come about to implement the system. But and in a sense, it's a one-off, right? But again, it's more than about the long-term sustainability. Um, Obviously you need volumes, right? And that sort of then kind of links to some of the previous points. How do you then make sure that, people are utilizing or using the system? How do you also use the existence of a fast payment system to bring about more financial inclusion? And here again, I think the role of the non-banks is very, very critical because in a sense, right, they also cater to the needs of different types of population segments that the traditional banking sectors might not necessarily have been able to cover or, or interested in, throughout the years. So again, I think sort of one more argument as to why it is important for the non-banks to be present and to be competing on an equal foot, so to speak. The other point is, related to again to how comprehensive the system is in order to make it appealing to the users to use it. By that, I mean having the ability to accommodate pretty much, all different use cases, be it domestic or cross-border transaction channels, as well as overlay services, right? The likes of an alias, right? Request to pay, confirmation of pay. These have become, almost an integral part of a fast payment system. If we talk about convenience and user friendliness and again, ability to use widely. And then of course we get to pricing itself, right? So obviously, the system operator has a particular, say in terms of what they are going to charge the payment service providers, meaning the system participants. And in a sense, I mean, in most cases, we're seeing, pretty reasonable and fairly, sort of low charges, right, when it comes to system participants. But of course, the tricky part and the challenge comes to end user pricing. And again, we're seeing a lot of experimentation, especially when it comes to the P2M or P2B, use case pricing at the point of sale. But the broader point I'm going to make is that in our view, it's important to really distinguish when it comes to end user pricing by use case. For instance, we're seeing many jurisdictions going for and feeling comfortable with zero sort of end user pricing for P2P. But P2B, right, person to business, person to merchant, they are ensuring that there is some charges that some fees that the PSPs can levy, right? Because at the end of the day, you want to make sure that you are not, there is some incentive, right, for the private sector to be in that space and operate, right? Like it cannot be obviously a zero sort of pricing throughout. There is no free lunch. Obviously, that cost has to be absorbed by somewhere. You could have initially some type of subsidy, as we're seeing some jurisdictions, but long term that's not sustainable, right? And we are seeing those discussions come up now. So it's better to have that type of strategy up front, right? How you're gonna sort of plan, design, and if you're gonna have some type of subsidy at the beginning, right? When and how that's gonna transition then to to a more sustainable model. So again, these are some of the of the reflections from our side, but it's definitely it's not an easy one. And I think unlike sort of, I'm just gonna kind of make an analogy, unlike the card industry that obviously has had decades, right, to kind of adjust a little bit and experiment. Fast payments still are fairly right nascent when it comes in the grand scheme of things, right? So I think over the next couple of years we'll see kind of a consolidation around the world in terms of kind of the pricing structures and mechanisms that I think will ensure also a more long-term sustainable path.
Holti, amazing answer. Thank you. I think you've built on what we learned and told us even more around that evolution of use cases is one of the solutions to one of the economics have to work question. And also, Sarah, I want to thank Jacqueline in absentia. What a beautiful statement So many pieces of that resonated with me. I love it if we can potentially make that public as well. Holti, so many great insights. Thank you so much. We're so grateful for your wisdom as part of this call. Sarah, back to you to close the call.
Thank you so much, Nadine. Thank you for Holti, because actually you answered one of the only outstanding questions in the Q&A with your last response as well. So we can now close. If we haven't heard your question, you can always reach out to me and I'd be very happy to either answer it if I can or pass it on to the panelists who could. And I'm just going to sort of conclude really our session. I just want to really sort of conclude by actually sharing what are we asking for? What do we believe will unlock fintech and non-bank participation? And we are advocating and calling for, transparent revenue pathways, proportional participation costs, stronger consumer adoption, and broader market participation in instant payment systems. We would like policy and that supports fintechs and non-banks. Examples being efficient licensing processes, proportionate capital and compliance requirements, and clear coordinated regulatory guidance from the different regulators, and even harmonized across multiple jurisdictions, but that might be a step too far right now. We would like IPS governance that focuses on both stability and inclusion, where there is active engagement, meaningful involvement, transparent communication, and accessible channels for indirect and direct participation. We would like to make sure that consumer awareness and literacy is a shared responsibility, that there's strong branding and consistent user experiences and literary tools that can accelerate adoption for consumers. And lastly, we would like technology that is reliable, that is harmonized standards, well-documented APIs, and predictable integration processes for fintechs and non-banks. Let me conclude by saying thank you to everybody who listened in on today's call. We had over 300 registrants and almost close to 200 people turning up to listen into this call. And we're very grateful for taking 90 minutes of your time today. I'd like to say a big thank you again to the 17 associations who supported this research, to the Interladder Foundation who made that possible, to all of our panelists today, Constantia, Ariane, Holti, Selassie, and Danielle. I'd also like to finish and say also a big thank you to Nandini. I couldn't have done this work without her and her expertise. So thank you very much as well to everybody. And we wish you all a wonderful day, and let's keep this conversation going. It's clearly resonating. It's clearly an important conversation and that needs to happen. So keep engaging with Alliance DFA, your local associations, and we will advocate to try and move the needle for this. Thank you so much, everybody. Bye-bye.
Thank you.